Your credit score is the most important three-digit number in your financial life. It affects loans, rent, insurance, even job offers in some states. Here's how it works. In this video, I'll explain what a credit score actually is, the 5 factors that determine it, the real dollar cost of a low score versus a high one, who actually sees your score, and 4 things to do this week to build or improve yours. Let's start with what a credit score actually is. A credit score is a 3-digit number, usually between 300 and 850, that predicts how likely you are to pay back borrowed money. That's the whole definition. It's a risk score for lenders. Higher number means less risk. Lower number means more risk. The credit score isn't a measure of your value as a person. It's a measure of your statistical likelihood to default on credit. The most common credit scoring model is FICO. There's also Vantage Score, used by some lenders. They produce slightly different numbers, but they measure similar things. Here are the FICO score ranges and what each means. 300 to 579, poor. You'll struggle to qualify for most loans. If you do qualify, rates will be high. 580 to 669, fair. Most lenders will work with you, but rates are above average. 670 to 739, good. You qualify for most credit products at competitive rates. 740 to 799, very good. You get the best rates from most lenders. 800 to 850, exceptional. You qualify for the absolute best rates available. About 1/3 of Americans have scores in the good range. Another 20% are in very good. The average American score hovers around 716. Now let me show you what actually determines your score. 5 factors with specific weightings. Factor 1, payment history, 35% of your score. This is the single biggest factor. Have you paid your bills on time? Even one missed payment can drop your score by 60 to 100 points. Late payments stay on your credit report for 7 years. Factor 2, credit utilization, 30%. This measures how much of your available credit you're using. If your credit limit is $10,000 and you're using $3,000, your utilization is 30%. The lower, the better. Under 30% is acceptable. Under 10% is ideal. This is the single fastest factor to improve. Factor 3, length of credit history, 15%. How long you've had credit, the longer the better. This is why you should never close your oldest credit card, even if you don't use it. Closing it shortens your credit history average. Factor 4, credit mix, 10%. The variety of credit you have, credit cards, auto loans, student loans, mortgage. A mix shows you can handle different types responsibly, but don't take out loans you don't need just for this. It's a small factor. Factor 5, new credit, 10%. How many new accounts you've opened recently. Each application creates a hard inquiry, which drops your score by 3 to 5 points temporarily. Multiple inquiries in a short window look risky. Spread out applications. Now let me show you the real cost of a low score. This is the part nobody explains clearly. A $300,000 30-year mortgage, same loan amount, different credit scores. At a credit score of 620, the typical interest rate might be 7.5%. Monthly payment, around $2,100. Total interest paid over 30 years, $390,000. At a credit score of 760, the rate might be 6%. Monthly payment around $1,800. Total interest paid $215,000. Same house, same loan amount, different credit score. $175,000 difference in interest over the life of the loan. That's not a luxury car. That's a house in some markets. This is the hidden cost of a low score. Every loan, every line of credit, every interest rate costs you more. Over a lifetime, the difference between a low and high score can be hundreds of thousands of dollars. Who actually sees your score? Lenders, obviously. Credit card companies, auto loan providers, mortgage banks, landlords. They run credit checks before approving rental applications. A low score can mean larger security deposits or outright denial. Insurance companies. In most U.S. states, your credit score affects your auto and home insurance premiums. A low score can mean hundreds of dollars more per year. Employers. In some states and for some positions, employers can pull your credit report with permission, particularly for jobs handling money or sensitive data. Utility companies. Cable, internet, electricity. Low credit may require deposits to set up service. This is why building your credit isn't optional. It affects far more than just credit cards. Here's exactly what to do this week. 1. Find your current credit score. Most major banks and credit cards show it free on your account dashboard. 2. Pull your full credit report at annualcreditreport.com. This is the only official free source. Look for errors. About 20% of reports contain mistakes that drag scores down. 3. Set up automatic payments on every account, even small ones, to never miss a payment. 4. Check your credit utilization. If you're over 30% on any card, focus there first. Quick recap: a credit score is a 3-digit risk number, 300 to 850. 5 factors determine it. Payment history is most important, utilization is second. Higher scores save you tens or hundreds of thousands of dollars over a lifetime. Lenders, landlords, insurers, and sometimes employers see it. Build yours by paying on time, keeping utilization low, and keeping old accounts open. If this helped, subscribe for more straightforward money education. And drop a comment with the credit score range you're targeting next. See you in the next one.